All right, ladies and gentlemen, what is happening today? My name is Bulldozer, and we are going to be taking a look at some serious marketing here. Now, if we are going to address what is currently happening with this capitulative state, we have to look at a few key elements, and we got to take it all the way down into fundamentals here. So, as you can see on the screen, I've pulled up the US 10-year Treasury yield. This is going to be very important to be discussed as it does have to do with inflationary rates, the hikes that we are currently experiencing, alongside with the tremendous down pressure that we are viewing with the markets as of today. So if we look at our actual 10-year bond, we can see that the rates have actually increased to a significant price that have surpassed last year's highs and actually managed to push all the way back into September of 2019 as a high. Now, our rates are currently sitting at 1.72%, which is still psychologically above what we do want to have in order to try to kind of flatten out the market and try to push a little bit green, looking onto a more longer term perspective here. So we are still inducing tremendous bear pressure as of current. Now, if our rates can manage to drop under the 1.7%, that is going to signify that we are starting to sink to levels where we can start to see some reversals coming into play. Now, having $1 trillion worth of excess liquidity in the market, which is visible in the reverse repos, is not necessarily a good thing. Okay? Now, with all of this being said, we have to address that any form of runoff that the feds will trigger is not going to be monetary tightening unless it all gets done without significant selling, right? Now, how long could this take? Theoretically, we could be looking at anywhere from 6 months to a year, and that's just on a natural aspect and a natural curve, right? Without them forcing selling, which could actually cause a devastating impact or pivot the entire market. You guys will have to excuse me here. I am a little bit sick, but it's not the Rona, so we're good. Now, rising yields does not have to do as much with the rate hikes, but rather has to do more so with the allocations towards new positioning. And I know that sounds kind of weird and off-putting, but from a technical standpoint towards the markets, when rates are up, people are not really going to be positioning that well, correct? We have to look at the influx of large money or institutional pooling, and we can see that it's running lower and lower as the markets continue to nosedive. Now, we're reflecting on nothing but bearish behavior and fear mongering. So smart money is going to be taking advantage, but at what rate? That is the most interesting point that we could address with this, right? So obviously the money will be getting poured back in, but it cannot be at an exponential rate. So we cannot start to see a large sum of accumulation starting to occur in between all the gaps that we are currently seeing, right? So there are key levels that can be addressed and key levels that we can play off. Now, is smart money going to be playing off the same technicals? We can try to assume so, and we can see large accumulations happening at that point. Will it be enough to reverse the markets as a whole? Probably not. Now, another important thing that has to be addressed is that when the feds were discussing the rate hikes that started to cause the entire market dip here, we'll take a peek. We'll go into SPY. We'll just take a nice look at this. We have a huge gap that is already happening. There was a psychological addressment of a key wording from the feds that included the term persistent rather than transitory towards the inflationary rate. Now, from a psychological response, that's a very bearish value to uphold, because they're essentially saying that no matter what, there is not really going to be anything positive coming out of it, rather that they're going to try to continue pushing it towards that aspect. So that is one of the reasonings in behind the current bearish momentum. And another issue that we do have at hand is that the 1.5% that's currently baked into the markets for rates versus the actual terminal rate, we're kind of sitting offset. So yes, our overall trend is still down looking at the long term, but it's gotten to the point of where it's actually greater than what the markets are currently being priced in at, which is another huge negative that, every big institution, company, investment firm is going to be addressing. And we can see that from the tremendous sell-off that is happening across the board. So if we do look at what we're currently baked in for, we're sitting at a 4 to 5 rate, which theoretically is that 1.5% that the markets are currently pushing and baked in for. But realistically, from the numbers that we should be seeing a 2% or just slightly above 2%. So it's not looking really positive right now. Yes, as of current, we are sitting on some technical levels that could be major towards us trying to have a temporary relief from the down pressure, but the overall term is extremely bearish in my opinion, and it's going to continue staying bearish for the next month, 2 months, possibly 3, 4 months. So the first thing that I'm going to be looking at is right where we're at currently on SPY. I'm going to be taking advantage for a long-term portfolio and slowly accumulating more positions on a greater scale. What I do want to see is that we do actually return back down and base towards 400 where we still have to fill in this gap. So if we're looking at the daily chart, we can see that back in it was April 1st of 2021. We had that gap that needs to be filled over there, and the markets are currently in position to nosedive down and give us the proper fill for that. So that's one of the major ones I will be looking at. A few other positions that I do want to try to take advantage of for the long term here is going to be anything revolving around the space of technology. Now, as contrary as that sounds currently, and especially with everybody getting out of all these risky investments, as people would label them now, I do think that the technology space is still in good hands for further advancement, especially for a long-term mindset. There's a lot of potential with these. Key players, you'll always have your Tesla, you'll have your EV space, you'll have some of your power companies. But some of the big players I do believe are going to be the ones that are getting into the gaming space, the metaverse, the chip production, anything around those lines. I do see greater value and more exponential growth coming out of them for the long term. So that is something I'm going to be keeping my eyes on. AMD, Microsoft, just a few key players there. But yeah, our overall term is bearish on the markets. I do believe we will start to see a little bit of a relief rally. Is it going to be lasting? Absolutely not. We do have the Feds that are going to be discussing this Wednesday. I will probably try to do an update video, but I'm just curious to see what is going to be happening there. So that is my current outlook on the market. I just thought I would address those for you guys, and hopefully everybody's staying alive, everybody's staying safe, and nobody's getting liquidated out of this game. But anyways, guys, I'll catch you on the next video.